Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about investing tips to get you through the rest of 2020. It just seems to be that, this year has been a tough year for most people, emotionally, physically, financially. A lot of things happening out there. So we're just going to talk about some things that can help carry you through the rest of 2020. And, both Tyler and I are football fans, and we look at this sort of as a football game. We're at halftime right now, halfway through the year. And we look at the first half, and again, if you look at a football game, we didn't really play that well, but yet the score isn't too bad. The market is recovering pretty significantly from its March 23rd downturn, its deepest trough of the year. But yet there are still some things that we need to look at. For instance, COVID doesn't seem to be going away too quickly, and we have no idea about vaccinations and so on. But the market is driven partially, both positive and negative, based on what's happening with COVID talks and progression. The other one is the election. The election this year could be sort of ugly. It seems to be that each election that comes upon us, they become more contentious and so on, and that does have an effect on the market. But I want to talk a little bit as we get into this about, election years. We discussed this earlier in the year. There's been 23 elections since 1928 through 2016. And whenever we talk to clients here in our office, many times they'll say, it's an election year, the market is going to go down. Well, first of all, that's only one part of it, the election. Again, we've got the COVID situation, we have unemployment and so on and so forth. So there's a lot of other factors weighing in on the market. But do understand, Tyler and I went back and looked at these election years from 1928 through 2016. Again, 23 elections. And we only noticed 4 times in the year of the election the market was down. When I talk to the market, I'm talking the S&P. For instance, in 1932, Roosevelt versus Hoover, the S&P was down a little over 8%. In 1940, Roosevelt versus Wilkie, the market was down, again, the S&P 9.8%. And then from there, from 1940, we had a run of all positive years during the year of the election all the way up to 2000. So that's a significant run of positive years. Some of them not real big gains. For instance, in 1960, Kennedy versus Nixon, the S&P was only up 0.5 point. But if you look at the year 2000, Bush versus Gore, the market was down a little over 9%, the S&P again. And then in 2008, Obama versus McCain, that was a bloodbath. The S&P was down 37%. So again, we're going to look at, investing tips to get you through the rest of 2020. Prepare for turbulence. We've been seeing an awful lot right now. We've heard of people that have gone to cash and unfortunately think that they made a mistake now when you see what the recovery has done. But Tyler, as far as, the election and the COVID and other things like that, what else is creating some of this turbulence? And to what extent do you think we're going to see that for the rest of the year?
Yeah, Dean, and you had some really good points there. But again, as we sit right now, we're just over a half, just under 2/3 of the way through the year. And the number one thing is to be prepared ahead of time. So you want to make sure that you're prepared for market turbulence or market volatility. And Dean, as you had mentioned, many people, they think with an election year that the market is going to crash or the market's going to go down. And as you just pointed out, historically, that's not the case at all, actually. Now, we will see the market will be volatile. That is almost for certain, but it's not a foregone conclusion that the market will go down because of the election. Now, it very well likely could, but as always with the stock market and investing, you never know. So what you have to do is simply plan and prepare for it. But going back to late March 23rd is when, from the beginning of the year to March 23rd, the Dow crashed down just under 35%. So that was the bottom, and the market's recovered nicely since then. But again, we have we have another third of the way to go before we're through the end of the year. And with all the unknowns, such as the election, such as the coronavirus, if the coronavirus worsens in fall and winter, we could see more measures that are taken by different, the president, governors, the local authorities that could impact stocks. Or on the flip side, there could also be, if the virus lessens or if there's a treatment or something like that, the market could turn around and continue to go back upward. So really what you want to do is, the number one thing is prepare for the volatility that could lie ahead, so that way you don't panic and start selling investments if they start to lose value at the wrong time. And unfortunately, we talked to a few people that did. They panicked in March and they sold when the market was going down. And if they were prepared ahead of time and if they stuck to the plan, they wouldn't have had to do that. And now they're sitting here when the market has recovered with some have a 10%, others 15%, others 20% or more losses because they sold at the wrong time. So ultimately, you want to stick to the plan. Usually for younger investors, that means continuing to, it's called dollar cost average, where you continue to put money into your 401k every single month. Continue to contribute, because if you continue to contribute every month, sure, there's going to be months where you're buying when the market's higher, but there's also going to be months like March, April, May where you're buying when the market is lower. And over the long term, that method has been proven to work the most efficiently. And again, that typically is what you want to do when you're younger, when you have a longer time horizon. But then for those people who are older, for those who are retirees and actively taking money out of their 401ks or their IRAs, that's where it's important to have an actively risk-managed portfolio. I know we have a lot of clients that like that, where we don't just put investments in there and leave them. What we do is we proactively risk manage, where we're constantly in contact with the client, letting them know what we're doing, where we're making little tweaks to the portfolio. If there's a position in there that we don't like, we can get rid of it. We can build up cash, have some cash on the sideline, so that way we can buy in if there is another downturn coming from now to the end of 2020. And that's what we'll get into the cash part in just a little bit here. But when we talk about actively risk managed portfolios for people who are retirees, it's always important to have cash built up. And right now could be a time where you look to build up some cash. Now that the market has recovered, you want to sell high and buy low. So again, the number one tip here to get you through the rest of 2020 is be prepared, stick to the plan.
Okay. One last thing on that too, Tyler, is, we hear from people coming into the office, they say, well, I can't wait till things get back to normal. I don't necessarily know if this might be the new normal. The volatility we're seeing over the last 2 years. Now, remember, last year, 2019, was a wonderful year based on most portfolios earned very good returns, through the year. However, it was still a very volatile year. We saw the market bouncing around like a ping pong ball. We're seeing that again this year. Is that the new normal? Don't know, but we need to make sure that we manage for that. So let's not more stability when you see, the market and the returns. Let's prepare for turbulence. Okay, the next thing we're going to talk about as far as, investing tips to get you through the rest of 2020 is have plenty of cash earmarked for emergencies. This is a big one. We just met with a client yesterday who's still sitting on a pretty significant amount of cash and is disappointed because, we've told him it's going to be very hard for us to get a decent interest rate on any fixed positions, whether it be CDs or money market or fixed annuities, something that they wanted to use as sort of a parking place for this cash until they needed it. This money was not going to be put into the stock market. They've got enough there already. They wanted to use it to get a better rate of return before they used it for emergencies or travel, which they've put off for now. But understand that in a low interest rate environment, there's no magic. It's going to be very hard to find some yield and some decent interest rates. But it's extremely important, though, to have this cash available. One of the problems we see during this time of a lot of uncertainty, both economic and financial uncertainty, is people are still reluctant to keep some money in cash to use for emergencies. And while they're not knowing if they're going to have a job next week or not, they're willing to go out and take a loan or put money on a credit card because they don't have cash positions. In today's economy and the way things are going right now, that's not a good thing to do. Build up that cash position. We'd love to see you in a cash position should the furnace go out, the roof needs repair, as opposed to having to take a loan. We hear it all the time. People will come in here and say, well, I can get zero interest on my credit card for X amount of months or years. Right. I mean, that sounds good. And if you run into a problem and have to pay it off after that time limit, you're going to be paying substantial interest rates on it. So let's look at building up cash positions.
Yeah, Dean, when it comes to building up cash that's earmarked for emergencies, that's the other investing tip, is having cash on hand for the rest of 2020. And there's often two different perspectives. The first perspective is your financial situation. So during any type of recession or any time when we're experiencing a lot of market volatility or the economy is recovering, an emergency fund, it is definitely necessary, and we've seen that with people losing their jobs. Now more than ever, people realize why you want to have an emergency fund and why you don't want to drain your savings or checking all the way down to zero. That way, if you do lose your job, you'll have cash on hand to tide yourself over and hopefully get you through until you can get another job or get back to work. And that's why we recommend having at all times, whether the economy is great or poor, at least 3 to 6 months worth of living expenses in your savings account. So, that's where it goes back to doing a budget, finding out how much you can live on, and then whatever that is per month. So, for example, if you find that you spend $5,000 per month, then you want to have at least $15,000, if not $30,000, in savings for an emergency if something were to happen, if you were to lose your job. That way you can still pay your bills, pay your emergency expenses until you get back to work or find a new job. Now, if your job isn't stable, then you can save more than that. You can do more than 6 months worth to try and build up that stability. So if you're in a sector or industry right now that isn't very stable, if you're in the restaurant business, the travel and leisure industry, you might want to save up more than 3 to 6 months worth of living expenses right now, just due to your particular situation. So again, the first perspective is financially. You want to make sure that at least 3 to 6 months worth of living expenses and savings. The other perspective is your investment perspective, and that's something that I just talked about, where right now would be a good time to have some money in cash, so that way if the market does take a dip, that money can be trickled into the market. You can buy low, sell high. It goes back to the old adage that we use all the time: buy low, sell high. If you don't have any cash on hand within your investment accounts, you can't buy low because you don't have any cash. And the other thing too is if you go into debt, or if you extend your emergency fund and buy different luxury items with it, then without any money in the bank, you're going to have no choice but to tap your investment account when the need for cash arises. And that could force you to take serious losses that you otherwise would have avoided, because if the market goes down and you need cash, then you have to sell your investments at a low point, and that's definitely what you don't want to do. So you want to make sure that you have cash built up in your checking and savings for an emergency, and then same thing within your investment and retirement accounts. It's always nice to have a little bit of cash there as well. And that more so applies for those who are heading into retirement or in retirement and they're taking money out. You always want to have cash on hand. You want to have cash set aside within your account. Because if something happens where you do need to access money outside of your checking or savings, you can take the cash from your IRA or from your investment account and use that, so that way you don't have to sell off an investment. You don't have to sell off your stocks, ETFs, or mutual funds at a low point. So again, the other tip here, make sure that you have plenty of cash earmarked for emergencies for the rest of the year.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next investing tip for the balance of 2020, and this one is one that it's hard for a lot of people due to emotion, but keep funding your retirement plan, or in some instances increase the funding to your retirement plan. As humans, emotion comes into play an awful lot. Unfortunately, emotion is a very bad trait for investors. Too high, too low, your emotions get the best of you when it comes to money matters. And an example of this is when the market was down substantially, we heard people wanting to cut back on their contribution to their 401k, when actually they should have been doing just the opposite. By cutting back at that particular time, they wanted to wait until the market started to pick up, became healthy before they started to invest. And again, that's absolutely contrary to what you want to do if you're generating or creating wealth during your working years. You probably would have been better off. You would have been better off had you actually contributed more, because when the market was down substantially, you were getting shares through your 401k or 403b at a much cheaper price. Therefore, you had the ability to have them grow and accumulate more. So when you buy shares at a cheaper price, it's better for you in the long run. So we want to see you keep funding your retirement plan during volatility, most specifically when the market is down.
Yeah, very good point, Sir Dean. But this is one where you have said it is pretty tricky. But you want to continue to fund your retirement plan, continue to put money away and save and invest. And we've seen it where, unfortunately, there are people where they see the market going down and they don't want to put money in anymore because they see that they're losing money. But I joke around at times on this one here, because it seems like it's the one situation where people don't want to buy something on sale. When you're shopping, you go to the grocery store, you're going buying clothes, you're on Amazon, you always want to buy things that are on sale. But if your investments are on sale, oftentimes people shy away from those. And I know there's the mental and psychological aspect where you see something losing money and you don't want to add to something that's losing money. But that's where it's important to keep a long-term perspective. If you're investing in good quality mutual funds, stocks, ETFs, you want to take a step back, look at the long-term track record, and know that, okay, the funds that you're investing in, they've made it through multiple different market cycles. So it kind of gives you a little bit more of a sense of relief, and just, you can kind of look more toward the long term as opposed to the short term. So that's one thing where we do want to be short term aware, but we want to be long term focused. Focus on the long term when it comes to investing. And really right now, if your income is held steady, but now you're spending less money than ever, considering that you're not really doing much traveling and entertainment, it's largely confined to your home right now at this point, without being able to go out and do sporting events, again, travel. So you're not spending as much. You have a really good opportunity to grow wealth by investing within your 401k or your IRA or your Roth IRA. So with that, you can contribute up to $6,000 into your Roth IRA, or if you're 50 or older, that bumps up to $7,000 this year into your Roth IRA. And then with your 401k, those limits are far more generous, where you can contribute $19,500 into your 401k. And if you're 50 or older, that jumps up to $26,000 that you can put away within your 401k. So the IRS does allow you to put a good chunk away in your investments and in your retirement plan. And right now, again, if your expenses are lower, you're not doing as much due to the whole coronavirus, that is the perfect opportunity for you to even bump up your contributions, provided your income is steady and you're in a steady job. Now, people then have the question of, okay, if I can contribute, how should I structure that? Should I go to a Roth IRA, a traditional IRA, a 401k? Oftentimes what we say is, if your employer does offer a match, so if you have a 401k and your employer matches up to 5%, then put the first 5% in the match, because it's free money. The employer match beats anything. So at the very least, go up to the match, because that's free money. Then after that, so go to the match, then go outside into the Roth IRA. See if you can max out your Roth IRA. Again, that's up to $6,000 you can put into your Roth, or $7,000 if you're 50 or older. Then if you're able to max that out, then go back to the 401k. And again, when we talk about putting money in, we recommend if you can try and work your way up to 15% of your gross income, that's the number that you want to target when it comes to going into the employer match, the Roth IRA, then back to your 401k. Now, the last thing that I'll mention with that is if your company does offer a Roth 401k, they weren't as common, but they're becoming much more popular, then you can even go all right into the Roth 401k, because with a Roth 401k, that is the same limits as the regular 401k, where you can put away $19,500 if you're under 50, or if you're 50 or older, that bumps up to $26,000, which could be a huge chunk that you could put away and have tax-free in the future. Again, the reason why we like Roth accounts is because all that growth over time is tax-free. So definitely want to continue funding your retirement plan from now through the rest of 2020, especially if your expenses are lower. That can afford you more money to put away toward retirement.
Okay. Another tip here for investing for the balance of the year 2020 is have a diverse mix of investments. This is extremely important. Part of the reason is, through the recovery from the March downturn, we've seen a lot of tech carrying the market. You see the Amazon and the Facebook and Google, Apple doing really, really well. That sector has been driving the market pretty substantially. You see a lot of other sectors, though, that are still down pretty low at this particular time. So what has happened then is a lot of your portfolio has drifted, is drifted away from the way it was balanced initially. Now is probably a time to go back and rebalance. Look at it before the election, because again, we believe in holding, investments for the long term, but you still need to be short-term aware. With the election coming up here, there are going to be certain sectors that come in favor and go out of favor. Just as an example, obvious observations here. If President Trump stays in office, you will probably see industrials and manufacturing strengthen, defense because of the amount of money he's put into our military and defense. I think you will see that continue to strengthen. Tech has been very, very strong under the Trump administration. He hasn't created any policies to break up some of the large tech companies. However, if Biden gets in, there's a possibility that, clean energy would continue to increase, healthcare would increase. So, regardless of who gets in, there are going to be opportunities, and unfortunately, there are going to be sectors that go out of favor. Do not create a portfolio exclusively around the election, though. That's a very dangerous thing. As we told you, there was only 4 times since 1928 that the market was down in an election year, and the S&P is what I'm referring to when I say the market. But still be aware of it. If it's time to rebalance, take some of these things into account. If you're significantly heavy on tech and there's a change of administration, tech might drop as a result. So make sure you're not too heavy now. It's a great time to rebalance.
Yeah, Dean, really, really good point there. So, when we talk about the last tip here to get you through the rest of 2020, it is just making sure that you have a diverse mix of investments. You hear about it all the time, that you want to diversify, you want to have diversification within your retirement accounts. But what that actually means is making sure that you have different sectors, different industries, because back in March, the market as a whole got hammered. Even some of the recession-proof industries, they took a pretty big beating. So that's why right now it's a good chance to go back, reassess your portfolio, make sure that you have some diversification in there. And right now, again, would be the time, because the market has recovered quite a bit. It's back up to where it was at the beginning of the year before this big downturn. And if you've held on since where your portfolio was at the beginning of the year and didn't make any type of wholesale changes, you didn't sell low, then your portfolio came back. So right now is the time to go and make changes that might be necessary before the market potentially takes another hit. And up until now, different growth stocks, tech stocks, and healthcare has really led the market. And it's really no surprise as to why, because if there's more people staying at home, you're doing more things with technology. You're having Zoom calls, you're shopping on Amazon even more, you're still using your Apple phone, you're still using your Microsoft computer. So you're using technology even more. So therefore, tech stocks have actually grown a ton in 2020 throughout this pandemic. But one thing that could happen is we could actually get a shift to more value or consumer discretionary or leisure if the virus does simmer down, and again, if there's some sort of treatment where people are back and traveling again, through the last third of this year, then there could be a shift into value. So you don't want to go and chase what has already happened. You want to make sure that you are prepared for what could happen from now to the end of the year. And again, this is where you want to go look back, maybe shift more so into value. If your portfolio went down and it scared you, but it came back up and you didn't sell low, maybe right now is where you want to take some of those gains off the table, move them more into cash, shift more conservatively. Right now, industries such as oil, airlines, and cruise lines are really beat up. And now that's the one other thing that I want to touch on before we end today's show here is we talk about this a lot, but there are clients and there are people that say, well, why don't we go into stuff that's super beat up? Now, keep in mind, you don't necessarily want to do that because some industries and sectors have much longer of a recovery than others. So shifting into value is different than shifting into things like oil, airlines, and cruise lines. But again, you want to stay diversified because it's fair to say that 2020 so far has been a year like no other, and it's not even over. We still have a third of the way left. But always remember that when it comes to investing, you want to be near-term aware, which is what we are, but always long-term focused, because if you look at the long term, if you look at the history of the market goes up over time. So be aware of the near term, make little tweaks, but always want to be long-term focused. And again, the last one here, make sure that you have a diverse mix of investments heading into the last third of 2020.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.